August FNB House Price Index has registered some gain in terms of year-on-year growth, but has declined compared to July, and that in terms of rate of growth. FNB Home Loans strategist John Loos calls it mixed signals, and he joins us in studio for more. Thanks so much, John, for joining us today.
Alishia.
Let's start off on that note, that we're seeing mixed signals and the differentiation really coming through when you're comparing year-on-year figures to month-on-month figures.
Yeah, it's not really mixed signals, but it can appear that to some people. When you compare year-on-year growth, when you look at year-on-year growth, there's a bit of a lag between an economic event until it and the timing until it features in the house price index. So we had a better summer in terms of economic growth. We had some good quarters there. We had further interest rate cutting late last year, and that just stimulated demand in the summer quarters for residential property just a little bit. And that's coming through into the year-on-year growth figures now. So up from a revised 4.8% in July, we have an August figure of 6.1% year-on-year. So that looks better. However, when you seasonally adjust the numbers, eliminate seasonal factors, and we look at it month on month just to see momentum, it's still growing by 0.6%, but that's down from early this year where it was at 1.3%. So it's losing growth momentum if we look at the month-on-month figures. And that's more a reflection of what came after summer. The winter quarter, the second quarter, we saw a drop in residential demand. We've had a lack of interest rate stimulus, and we've had a significantly slowing economy having a slightly negative impact on the residential property market.
Bottom line here is we're looking at a weakening demand picture here, and to consider are some of these factors that you've highlighted. To what extent do you see prospects improving, with there now being talk of a possible rate cut on the cards moving forward?
Well, I think a rate cut is a distinct possibility, but I must just warn that is due to what looks like a sharply weaker global economy. The risk of recession is not insignificant either, but whether recession or not, significantly slower economic growth globally, significantly lower inflationary pressures. So there was a good side to it, but there's a bad side to it. Economic growth affects the housing market very significantly too. It's not just about interest rates. So a rate cut would be a bad news rate cut. It would be with weaker inflationary pressures because of a far weaker global and local economy. So either way, it's not a wonderful story for residential property, well, or for other sectors by the looks of it either.
Absolutely. Let's drill down into that demand-supply dynamic that's currently at play, because on the one hand, you've got, as you highlighted and touched on a little earlier, you've got demand slackening, but one would have assumed that supply would be slackening as well, given the fact that you've got very little new building taking place and possibly homeowners holding on to their existing properties for longer.
Well, there's a lot of financial pressure, pressure-related selling. Our estate agent survey in the third quarter estimated that 25% of sellers were selling to downscale due to financial pressure. So that contributes to a good supply. And then there are people that, for various reasons, may have wanted to sell their house but are waiting for better economic times, or what they perceive as better. And what we seem to see, according to our valuers last year and earlier this year, is an improvement in supply. Their perception were an improvement in supply. I think what happened was people saw, would-be sellers saw, hang on a moment, interest rates are lower, demand should be significantly better. Now is the time when I can possibly get my price, whereas a year or two ago it wasn't. And so it seems like supply improved during the two summer quarters and has stayed fairly good. So there's been this mismatch between demand and supply. Demand did pick up a bit in the summer quarters, but has dwindled again. But according to our valuers, significant imbalance still when it comes to demand versus supply. And that would suggest to me that there's still got to be some significant correction in the market. It doesn't have to mean nominal house price decline always. A lot of the correction, if we look at in real terms and we adjust for CPI, we've had a real decline since early 2008 of 15.4% in the index. So a lot of the correction doesn't take place in terms of absolute or nominal house price declines. It's where house price growth still takes place, very low, but stays below inflation and below wage increases for a good number of years. And we've probably still got quite a bit of that to come.
How much longer will those who have been holding out for better prospects have to wait? And I'm alluding here to your outlook within this space moving forward.
Well, if you just look as a rule of thumb, the average big property cycle is 15 to 20 years. The last big bottom being about 1998. So we're about 12, 13 years into that. So that would suggest a few years to go. But why I think it's plausible that it's still a good few years to go is because of the global economic outlook. There's not a lot we can do about that, but the biggest economy in the world, the US, I think is in serious trouble. And across the ocean in Europe, they're also in serious trouble. That bodes ill for economic growth in the world for a couple of years, I believe. They've run out of stimulus measures. When you cut your interest rates to naught, there's nowhere else to go. So that's the unfortunate reality of the world we live in at the moment, and that does impact on our economy. Absolutely. And it does impact on our housing market, unfortunately.
Absolutely. Diminished firepower to get things going is what they're calling it. Yeah. Thanks so much, John, for joining us this afternoon. Of course, John Loos is Home Loans strategist over at FNB.